Seth Stewart coming to you here from Brookstone Financial, and two things I really want to discuss today. Now, we have just over a month before year end, and now is the time to consider converting to Roth IRA. Now think about it, folks. We have $23 trillion worth of debt. The likelihood that taxes are going to increase in the future is pretty good. And the best time to shop is when things are on sale. So consider paying taxes on tax-deferred retirement accounts while taxes are still on sale. Now for Roth conversions, you have to do so before year end or before December 31st. Two things working in your favor right now when it comes to converting. First of all, we've seen a recent tax cut. So overall, we've seen about a 3% tax cut when you look at the individual brackets. Furthermore, standard deductions have doubled, meaning that your taxable income on paper is much less, giving you more room to convert. Let me show you what I mean. So first of all, if you take a look at the 12% federal tax bracket. So the top of this 12% federal tax bracket is around $78,000. Let's say I have a client come into the office and I see that their taxable income for the year is $58,000. Well, in that year, I believe it makes a lot of sense to consider converting the additional $20,000, going ahead and paying the taxes to simply maximize the tax bracket that you're already in. And again, taxes are on sale. The best time to shop is when things are on sale. Well, why does this matter? You know, what's the long-term advantage of converting to a Roth? Number one, whatever you don't spend in your lifetime goes to your beneficiaries tax-free as well because you've already paid the tax. It also grows tax deferred. And again, if you take the withdrawals out after 5 years, the withdrawals are tax-free during your lifetime. More importantly, though, during your lifetime, it minimizes your required minimum distribution at 70.5 because when you turn 70.5, you're forced to start taking money out of your accounts. Whether you need the money or not, remember, Uncle Sam has a $23 trillion debt. We wish it was 23,000. They have $23 trillion in debt. They need the money more than you do. So RMDs are forced upon you at 70.5. And what are the effects of RMDs? Let me show you something here. Because again, keep in mind, at 70.5, you lose control of what may be one of your largest assets. A lot of folks are really upset about paying taxes on Social Security. And one of the reasons why they're taxed on Social Security or paying unnecessary taxes is because of their RMD. They have this forced taxable income. Again, they may not need it at 70.5. And let me give you an example. We're going to talk about two individuals. We're going to say this individual has a $100,000 IRA, right? $30,000 of income or adjusted gross income and a $24,000 a year Social Security benefit. Well, their provisional income, and folks, provisional income is what determines how much in taxes or how much actually of your Social Security benefit is going to be taxed. Provisional income is your AGI basically plus half of your Social Security benefit. So in this example, provisional income is $42,000. We're going to assume this is married filing jointly. They are in the 50% threshold of taxation on Social Security. It means that half of their benefits being taxed. Well, let's say that now they turn 70.5, and remember, you're forced to take out these required minimum distributions. So at 70.5, they have to take out an RMD on this $100,000. And the RMD at 70.5 on $100,000 is going to be roughly $3,600. So we add that $3,600, now we are at $45,600, which throws us into the 85% threshold of taxation, meaning 85% of our Social Security benefit is now taxed. How can we avoid that, or how can we minimize it? Let me give you an example. Back to Roth conversions. Let's say this individual converts half of that $100,000 to Roth. So now we have a $50,000 IRA and we have a $50,000 Roth. So same numbers, $30,000 of income, $24,000 of Social Security, meaning $42,000 of provisional income. Right now, they're 50% threshold of taxation, 50% of their benefits are taxed. So now it's RMD time. They turn 70.5. Well, the RMD is only based upon the IRA and not the Roth. So because of that, we can basically split the RMD in half because we converted half of the Roth for simple math $1,800. Now we're at $43,800, and the threshold to stay below that 50% taxation is $44,000. So we're still in the 50% threshold of taxation. Folks, this is why it all matters. This is how it comes together. People ask me all the time, how do you get the most out of Social Security? It's all about coordination. Coordination is the key to getting the most out of all your benefits when it comes to retirement planning. If you want to get more out of what you've got, I would encourage you to go to our website at brookstonefinancial.com. On our website, you can actually request a copy of my new book, Innovations in Retirement Planning, How to Get More Out of What You've Got. We also offer 1-hour complimentary one-on-one consultations. If you'd like to take advantage of that, give our office a call. It's 812-288-9000. Again, that's 812-288-9000. We look forward to seeing you soon.